Hello guys, welcome to i-tutor Academy. In today's session, we will start with Unit 5 of MMPC-003. It's an Indian financial system. Let's see the objectives of this chapter. After reading this unit, you should be able to explain the importance of the financial system, describe the structure and working of the money market and capital market, outline the structure of the banking system, and examine the working of the capital market along with its various instruments and intermediaries. And let's see the structure of this unit. It's an introduction part is there, and financial system and working of financial markets, structure of money market, banking structure in India, Reserve Bank of India, scheduled bank in India, structure of capital market, summary is there, and keywords and self-assessment questions also. So let's begin with the introduction part. Before dwelling into the various intricacies of the financial system, you need to understand capital accumulation and its importance. And in the previous unit, you have read about different theories of economic growth and have realized that for an economy to achieve higher levels of both economic growth and indeed economic development, the role of capital formation is indispensable. Capital formation means an addition or increment in the existing stock of real capital available in the country. And capital in economics terminology does not mean money alone. It is a wider term that encompasses both physical and human capital. Physical capital like machines, tools, infrastructure, raw material, etc. leads to more production, profit, and the creation of assessment in future. Human capital, on the other hand, includes skills, training, education, etc., which improves the productivity of individuals and especially labor. Saving and investment are two core components of capital formation. Saving in the simplest sense means the part of income that is not consumed. When saving is used in such a manner that it gives returns in future, it becomes an investment. For example, you saved a certain proportion of your income and bought a piece of land. So buying land is an investment because if you sell it, then the sale price of land will be higher than your purchase price and the margin between the two will be the profit. Now instead of selling that land, you constructed a building on that land and then you gave it on rent. So this rent will be an extra income for you and it will add to your current level of income or profit. So when saving are properly channelized, it increases the stock of income or capital. As saving is important for an individual, it is of paramount importance for an economy. A higher level of savings leads to more investment and capital formation, which in turn become the source of economic growth. So it is the creation of savings, mobilization of savings, and conversion of savings into capital assets that lead to capital formation. And there are large numbers of factors that affect the rate of capital formation in the country, like income level of the people, institutional factors like availability, number and coverage of financial institutions, the monetary and fiscal policy of the country, prevailing rate of interest, population, size of the market, etc. And the next is financial system and working of financial market. A financial system consists of a set of institutions, instruments and markets which bring the savers and the investors to a common platform and provide the means by which savings are translated to investment. The principal objective of the financial system or financial market is to channelize the savings into the most productive opportunity or avenues. In financial market, there are two players, namely lenders and borrowers. Individuals or households generate savings and have surplus funds. They can either put this amount of money in gunny bags and hide it, or keep it under lock and key as was done in years. These forms of savings did not yield any return, and the constant fear of theft always lured upon the savers. On the other hand, capitalists or entrepreneurs could not undertake new project of production or expand the existing production capacity of the plant due to dearth of capital. The major role of the financial system of financial market is to bring these together. And the working of financial market can be understood from the flow chart. There is one flow chart is there, lenders or individuals or households is there, savings is there, next is financial system, then there is a loan system is there, there is borrowers of financial system, say borrow karte hai, right? So this is the household saves money in the financial system, and these funds are channelized and in the forms of loan are provided to the borrowers. So this is the working of financial market in the economy. And financial markets perform many functions like to connect borrowers and lenders of funds and to lead to the process of price discovery or determination, to provide liquidity in the system by allocation of funds in an efficient manner, easy access of funds to the borrowers, which in turn reduce the cost of the transaction and provides a way for managing uncertainty and controlling risk. And next is structure of money market. Financial market have two main components, money market and capital market, and they both are essential for the economic development of the country. In the following section, you will read about the money market, its important and various instruments. The money market is a market for short-term financial asset and assets which are close substitute of money. Short term implies time period of less than 1 year, and close substitute of money refers to those financial assets that can be converted to money with minimum or no transaction cost and without loss in value. The major participants in the money market are scheduled commercial bank, that is excluding regional rural bank or RRBs, and cooperative bank, that is excluding land development banks and primary dealers. And objectives. The broad objective or functions of the money market are to provide equilibrium mechanism between short-term surplus and deficiencies, maintaining liquidity in the system, providing access to short-term funds to the borrowers at a minimum or realistic cost, to enable the central bank of the country intervention to influence and regulate liquidity in the economy. Instrument of the money market. The main instrument traded in the money market and the sub-market are call market or notice market, commercial papers, that is CPS market, treasury bills, that is T-bills market, commercial bill market, certificate of deposit market, money market, mutual fund. Let us now discuss them in brief. Okay, one by one there is an explanation. What is call market or notice market? It is a market for short-term financial funds payable immediately and in full when the lender demands them. It is for this reason that call money is also known as money at call. Okay, next is commercial papers or CPS market. CPS are short-term unsecured instruments issued by companies to raise short-term debt. They are issued in the form of promissory notes, and in India they were introduced in 1990. Large corporation, primary dealers and financial institutions are authorized to issue CPS. And next is treasury bill or T-bills. T-bills are short-term borrowing instruments by the government of India. These are a form of a bill that does not arise from any genuine transaction in goods. They are a kind of promissory note issued by the Reserve Bank of India. And next one is commercial bill market. Commercial bills and market. Commercial bills include bills of exchange and promissory notes. A promissory note is a form of financial instrument in which the notes issuer and the notes payee undertake a written promise whereby the issuer promises to pay a definite sum of money either on demand or at a specified future date to a particular person or to the bearer of the instrument. And next is certificate of deposit, that is CDS market. CDS are negotiable money market instrument against funds deposit in a bank or other financial institutions for a fixed time period at a specified rate of interest. They are the bearer documents and issued in dematerialized form. Scheduled commercial bank, that is except RRBs and local area bank and selected all India FIs can issue CDs in minimum amount of Rs 1 lakh and in the multiple of Rs 1 lakh. The maturity period of CDS is a minimum of 7 days and a maximum up to 1 year. And next is money market mutual funds, that is MMFs. To increase the participation of individuals and small investors in the money market and to provide additional short-term funds avenue to the investors, MMFs were introduced in April 1991, and the detailed scheme of MMFs was announced by RBI in 1992. A mutual fund is an investment scheme mostly run by an asset management company. Structure of money market in India. The structure of the money market in India is presented in figure 5.2. There is one figure. The money market is divided into two parts, that is organized and unorganized. Organized, there is RBI, commercial banks, etc. And unorganized, there is indigenous bank, non-banking companies, money lenders, etc. Okay, and the organized sector consists of the Central Bank of India or RBI commercial banks, both nationalized and private. Further, the foreign banks, cooperative banks, and discount and financial house of India and other financial institutions like IFCI, ICICI, LIC, GCI and mutual funds also operate in the money market. The unorganized sector consists of non-bank financial intermediaries, indigenous bankers and money lenders. So this is about today's section. Next section of Unit 5 we will discuss on next video. If you have any doubt, you can comment it on our comment box. Also you can message our contact number also. Thank you so much.
i-tutor ES presents Ignou MBA complete syllabus coverage classes and individual semester base subject coverage program for MBA students online and flexible sessions. For more details, contact 62382 17885.